Hello, hello. Welcome back, everyone, to Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. Today, we'll be looking at the current rally and how it differs from the spring bull run. We'll take a look at the derivatives market and activity on-chain as I lay out a thesis for you as to why I feel that price is in a healthier place now than when we hit 50K earlier this year. Let's get right to it. Where we begin today is revisiting entity-adjusted activity on-chain. If you recall from my previous video, I went through what entity-adjusted transactions were. Basically, entity adjustment just means that there's no self-dealing included in this metric. So if I were to transfer coins between a couple of my addresses, that wouldn't show up as a transaction on this orange line here. The blue line is the count of individuals participating in the transactions shown in the orange line. The number of active entities is what you see in blue. If you look at the trend of these lines, it's pretty clear that when we have a bull run, activity goes up, and on the backside, activity goes down, sometimes quite dramatically. When we are in consolidation, sideways price action, it can be a bit choppy. It's hard to kind of discern a trend. Sometimes there's big spikes as price recovers from lows, but mostly just kind of chops around. If you direct your eyes towards the end of 2020, when we had this recent bull run, there was a spike in transaction counts and active entities on the chain at the same time. But one thing that's very curious to me between January 2021 and January 2018 is that when you look at the last blow-off top for the market, the activity and the amount of entities performing those transactions hit its high at the blow-off top. It increased as price increased, and when we hit the top, it fell off and price declined. But if you look at 2021, active entities increased, transaction counts increased as we hit 2x of the previous high of 20K. We broke it here, we pushed up to 40K, and that was really like the peak pinnacle moment of activity on chain and peak retail interest. But what's interesting is the price just kept going. It chopped around. It's not a clear run by any stretch, but it appreciated another $24,000 or so in spot before finally rolling over in mid-May. But what's really intriguing to me about that when viewed on this chart is just how much activity fell off before we ever got to that point. Look at it. Once again, orange is count of activity, blue is count of people doing the activity. The top is here, 40K. People cashing in 2x profits maybe from the previous high and just getting out. So what's going on over here? Well, how can we explain what this rally is? Is there anything going on now in our current rally that mirrors any of this? What can we learn from it? Where we might look for the first clue is on the spent volume age bands. In the previous video, I talked about the spent output age bands, which are the counterpart to this chart. Where the spent outputs is the count of raw activities, raw transactions moving each day and their age. This is the underlying volume of coin inside those transactions. So you get a better idea of the total liquidity moving each day and how old it is. If you look here, this is the bull run. September 20th all the way through January, this is the original breakout of the bull run. Right around this point here is the 40K pullback we mentioned earlier. This is the moment where price was essentially 2x of the previous high around 20K. See here, the spike in activity. One thing to mention is that the only activity you're seeing right now is from coins that are 6 months or older. Each of these colors is a different cohort in this big group of coins that are 6 months to over 10 years old. You can see here, as we got closer and closer to the 40K eventual, what I'm going to call mini top, you see the activity of older hands building as we reach the apex, and then falling off significantly down to kind of a basin level, about 2.5% of daily volume. But here, this is the top for old hands. This is the moment where they realized gains into market strength, exiting their coins, selling them to younger hands, and essentially resetting for the next wave of the market, as they always do. In the previous video, we talked about how long-term holders, that's people that have held the coins for over 5 months, tend to sell into strength on market tops and accumulate in market resets. Well, this looks like that moment, doesn't it? So what happened over here? The price just kept going. This isn't exactly a blow-off top, but it's an appreciation of nearly $24,000 in spot price, from the 40K around here all the way up to here. So what was driving this rally? If it wasn't old hands selling, what can we look at in the data to figure out what happened here? The next chart I want to look at is showing us the amount of Bitcoin that is sitting with entities that have at least 1,000 coins. So these are the big whales, big spenders. We have taken out exchanges and things like that, so that what we're really left with is the pure individual entities on chain. And there's going to be some other smaller institutions and companies in there that we don't have heuristically separated on Glassnode, but this is still a good representation of the whale balance. One thing that you'll notice here is the same trend that we saw with entity activity on chain and with the spent volume age bands. In both instances before, we noted that activity dropped off precipitously after the top at 40K in January. You can see that point here. This yellowish, goldish line here is the supply with whales that we mentioned. Well, look where it peaks. Right here. Now, this isn't the top itself, but it's within the same area of the bull run. And this moment here is significant in its own right, because this is the moment the price reclaimed the high. So think about this for a minute. We're in this long bull run. Some of the people in this bull run have been in the market since the previous high back here at 19,500 in 2017. As price breaks the previous high, you start to see more and more activity on chain, as we noticed in the entity charts here. As price starts to break up towards over 20K and towards 40, right here, this is where you really start to see entity activity picking up on chain. It's also the same place that we see the rollover of whale supply. What I find very interesting is that they waited for price to get back over the pullback. This is smart money. If you remember yesterday's video, we showed long-term holder supply and how as price breaks the previous all-time high, they sell into market strength, realize gains into liquidity, and reset for the next market. They go into accumulation mode on the backside of bull runs, and then as we approach a next high, they start to sell again. Well, here, the whales operated a bit similarly, where old hands and long-term holders as a bigger group tend to start selling into strength. The whales, in this example, continued to hold up through 40 and through the pullback. They waited for price to reclaim 40,000 before they sold. This is the moment that they began to roll over. This is when they started to relinquish their holdings into liquidity and reset for the next market. You can see precipitously the fall. You could also notice right here is when a bullish divergence appears between the price and the amount of supply being held by these large entities. Price declining into weakness into the summer as the supply held by these large entities begins to grow. This is another visual representation of big money and savvy investors buying the dip. The first place we'll look to understand the rest of the rally is futures open interest. So futures and options both make up the Bitcoin derivatives market. Traders that participate in derivatives are not buying and selling the underlying coins. They don't possess them in the trade. Instead, they're kind of betting amongst themselves about what they think the price will do, and they're collateralizing those positions with something of value. They can either collateralize them with other Bitcoin and other crypto, depending on the exchange, or they can collateralize it with cash and cash equivalents like stable coins that are pegged to the dollar, USDC, Tether, etc. One thing that I'll note here, I'm going to switch back and forth between this chart and the spent volume age bands chart we just looked at a moment ago. Note here, this was the old hand spending volume in the spot market. This is old hands realizing gains. This is the typical behavior you see in a blow-off top in a bull run. And then it just falls off. Right after that moment, futures volume begins to accelerate dramatically. Why this happened, I'm not entirely certain. Maybe an exchange changed some of their offerings. Maybe a big player stepped in that caused more volatility and created additional interest through a network effect of some kind. The actual reasoning isn't as important as the effect it caused on the market. So again, look at how the spending volume in spot fell off, just as futures interest is increasing. That's pretty interesting to me. It makes me think maybe the futures market is to blame, or at least partially the culprit, behind how price continued to rise, but it wasn't able to realize the same kind of highs at the same pace that you would expect in a proper blow-off bull run. This is the futures perpetual funding rate. It isn't important to go over everything in the futures market. To be honest with you, I don't fully understand every piece of it, but the funding rate is a key component of the ecosystem. So the way the funding rate works is it charges a premium to the traders that are in the majority bias, and the amount that they pay is calculated in order to tie the exchange's contracts to the spot price. And it's a way of incentivizing the other side of the trade and kind of encouraging balance in the futures market. I say all that to say that when you look at the chart, when you see a bunch of green bars building in one direction, it's like a rubber band. It's like the bias is getting pulled tighter and tighter to the long side, to the price go up side. Whenever that turns out to be wrong and the rubber band has been pulled back hard enough, there can be quite a precipitous snap in the other direction. This started happening quite a bit in the spring of 2021. We noted earlier that on-chain volume, that is spot volume of people trading the coins back and forth, started to decline around the 40K mark. We went over that earlier. Around that same time, just after spot volume started declining, futures volume started increasing from around 12.5 billion a day all the way up to the 20s, 25 billion, maybe a 100% increase. So what you can tell from those two charts is that spot volume really died off after 40K. The casual retail interest that helps to drive rallies and help move the price really quickly, and you get those parabolic moves that just send us into orbit, those are often helped and propelled by casual retail just FOMOing in, just pressing the market buy button. They don't care what the price is. That happens on every blow off top. But after that moment, it was really the derivatives, the futures volume especially, that started to drive the rest of price discovery. And what you ended up having, a lot of these quick reversals in price, since spot volume was so low, were driven by liquidations on both sides in the futures market. There were liquidations of long traders and short traders. This quick and dirty chart here is showing you those liquidations. The colors are the short side and the long side. People who wanted price to go up are in green. People who wanted price to come down and were wrong are in red. These are the people whose positions got liquidated automatically by the exchange because their margin requirement exceeded their collateral. They didn't have enough money to cover their cost. And you can really see, look at the activity here. Look at all of the spikes of red and green volume. We're not going to really go through how much each of these are. The point is to look at this block of activity here from February to May, and then how quiet it has been for much of the summer. From here to this. This is what drove a lot of this up here. And because spot volume had declined, there was not enough demand waiting to buy up the coins as they were getting liquidated. Particularly these two big ones here that we covered in yesterday's video. So the point I want to crystallize here is that what happened to us in the spring was not any kind of failure of Bitcoin. And it doesn't change the bull bias that I have for the overall market health. On-chain's underlying supply dynamics still look extremely healthy, as we covered in the first video for this channel. The futures funding rate has been growing to the positive side over the last few weeks since late July, but it is still only a third or less of the highest points it was at in the early part of the year. The leverage is not there in the system, though we are seeing a healthy increase in futures volume, up about 68% from the low here in late May. In my view, this is very healthy. A bustling derivatives market is good for price discovery. It's not a bad thing. What caused the crash and what we need to look out for going forward is that we don't see too much leverage getting into the system. If we start to see this funding rate getting back up here over 0.05%, kind of up into this higher area, and we see futures open interest back up into the 25 billions, we could have some short-term downside risk. I'm still overall feeling confident because of the underlying supply dynamics. But this is something to keep monitoring, and I do believe that it is a different kind of market top than what we have had in the past. And I don't anticipate future tops to be exactly like this one. The last chart I want to touch on before we go is revisiting the illiquid supply shock ratio that we talked about in video number 1. Again, illiquid supply is representing the amount of coins sitting with entities who are not likely to sell. That is represented here on the blue line. The orange line is the exchange supply shock ratio. It is the amount of coin not on exchanges versus the amount of coin that is on exchanges. So for those who don't understand, we consider coins being pulled off of exchanges a bullish sentiment. It shows confidence in the asset because in order to sell your coins, you have to have them on the exchange because that's where you place them to get buyers. If you have taken them off the exchange, you probably have them in cold storage, you probably have them in a hardware wallet, and you aren't looking to offload them anytime soon. So whenever we see large exchange outflows and it looks like a lot of supply is being pulled out of them, we consider that bullish. Well, if you look over here at this chart, illiquid supply and exchange supply shock ratios are both on the uptick since the low here. This is the low, but you know what I mean, since the summer, since the kind of bearish summer that we had. We've had a notable increase in the value here. It stayed kind of flat and we've ticked up again. This is good. This is good. We want to see this. This is helping to reinforce that the underlying supply is still being pulled away. There still remains confidence in the asset. And then what we really need to be watching out for is this kind of thing. So I hope that everything we've gone through today made sense to you. I hope that I've laid out a clear thesis as to why I feel that the spring bull run was different from what we would expect and what I think we should look for going forward so that we don't repeat history. This is only my second video. I'm still learning how this YouTube process works. I'd love to hear your feedback in the comments about what you thought about this video, what you think I can do to improve, any questions you have, and other things you'd like me to cover. Please like it. Please subscribe. Please hit the bell icon so you can find out when I post another one, and share it around. I'm having so much fun talking about this with you, and I really hope that you are getting excited about on-chain data and the kind of badass insights that we can pull from it. It's just endlessly fascinating to me, and I just hope that you guys are enjoying the content. Please follow me on Twitter at TXMCTrades. I post a lot of intraday analysis, in-the-moment observations, smaller things that don't make it to the videos. As we're filming this today on September 7th, we have had a noticeable pullback in the Bitcoin price. It's now trading around 46,000. Looks like it bounced down around 43. I strongly feel that this is a byproduct of what we just reviewed in the video you're watching. This is about the futures market. There's some big liquidations that went through today. Maybe we'll update that later. You can see it on my Twitter if you go check it out today. This is the kind of thing we're talking about. And if you follow me and we start to learn more about this together, we can see these things coming a little more clearly. So please, I implore you, follow me along on this journey and let's just keep it going. I'm having so much fun. Thank you for all the support. I will see you in the next video. Cheers.